Hi guys, welcome to the channel. So today we're going to discuss a topic that's crucial for property owners: how to avoid taxes when selling their property. We'll compare the tax implications for married couples versus single individuals. We'll cover tax deductions, capital gains tax, and 1031 exchange. Now, remember, this video is for informational purposes only. Always consult with a tax professional for advice tailored to your specific circumstances. All right, let's get started. Capital gains tax. When you sell a property, you may have to pay capital gains tax on the profit. The tax rate depends on your income and your filing status. For example, in 2023, married couples filing jointly won't pay any capital gains tax if their total taxable income is $89,250 or below. However, they'll pay 15% capital gains tax if their income is $89,251 to $553,850. Above that income level, the rate jumps to 20%. I'll get into that a little later. For single filers, the thresholds are lower. For the 2024 tax year, they won't pay any capital gains tax if their total taxable income is $47,025 or below. The 15% rate applies if their income is $47,026 to $518,900. Of anything above that, the capital gains tax jumps to 20%. There are several tax deductions you can take when selling a house. These include selling costs, home improvements, and repairs, property taxes, and mortgage interest. For example, you can deduct costs associated with selling the home, such as legal fees, escrow fees, advertising costs, and real estate agent commissions. If you made home improvements within 90 days of the closing to make your home more marketable, you can deduct those costs as well. Married filing jointly versus separately. Married couples have the option to file their taxes jointly or separately. If you file jointly, you can exclude up to $500,000 of gain from the sale of your home. If you file separately, each spouse can exclude up to $250,000 without paying any taxes. For example, if a married couple sold their home for a $300,000 gain and had a $300,000 in other income for the year, their total taxable income would be $600,000. At this income level, they would pay a 20% capital gains tax on their $300,000 gain for a $60,000 tax. A 1031 exchange, named after Section 1031 of the IRS Code, is a strategy that allows real estate investors to defer capital gains taxes when they sell an investment property and reinvest the proceeds in a like-kind property. So basically something similar, another investment property. This means that any type of investment property can be exchanged for another type of investment property. The process of a 1031 exchange involves several steps. First, the investors sell their investment property. The proceeds from the sale must be transferred to a qualified intermediary rather than the seller to avoid immediate taxation. This intermediary holds the funds in escrow until they can be transferred to the seller of the replacement property. Next, the investor identifies potential replacement properties. The IRS has specific rules about the timing and number of properties that can be identified. You basically have 180 days to close on another property and 45 days to identify 3 replacement properties. After that 45-day period, you're not allowed to make any more changes or to update the list of identified properties. Once a suitable replacement property is found, the investor uses the fund held by the intermediary to purchase this property. If all IRS rules are met, the investors can defer capital gains taxes on the sale of the original property. It's important to note that a 1031 exchange is generally only for business or investment properties. Personal residences or vacation homes typically do not qualify. Also, while a 1031 exchange allows for the deferral of capital gains taxes, it doesn't eliminate them. The deferred taxes will eventually be due, typically when the new property is sold. However, there are strategies to further defer or even potentially eliminate these taxes, such as through estate planning. Given the complexity and strict requirements of a 1031 exchange, it's recommended to consult with a tax professional or a qualified intermediary to ensure all rules are followed. Remember, this video is for informational purposes only and does not constitute financial, tax, or legal advice. Please consult with a tax professional before making any decisions. That's it for today, guys. Please don't forget to like, subscribe, and share this video. Until then, take care and happy investing.